Are you prepared for the next stock market crash? The question may seem daunting, but it's a reality we must face. A stock market crash, for those who may not know, is a sudden, drastic drop in stock prices. It's an inevitable part of the economic cycle, a storm that eventually hits every investor's portfolio. The impact can be significant, potentially wiping out years of growth and profits, but fear not. The purpose of this video is not to scare, but to enlighten, to guide, to prepare. We'll delve into the nuts and bolts of stock market crashes, why they occur, how they can affect your investments, and most importantly, what you can do to safeguard your portfolio. Because remember, it's not just about surviving the storm, but how well you weather it. Fortune favors the prepared, and today, we are going to arm you with knowledge and strategies to weather the storm. To prepare for a crash, you must first understand what it is and why it happens. Now, let's delve into the history and causes of stock market crashes, with a special focus on the infamous crashes of 1929 and 2008. The stock market is a complex beast, powered by global economies, corporate profits, and human emotions. Sometimes these elements align in a perfect storm, leading to a sudden and dramatic drop in stock prices. This is what we call a stock market crash. Historically, the crash of 1929, also known as the Great Crash, and the 2008 financial crisis are two of the most notable instances. The 1929 crash was a result of speculative trading and unchecked credit, while the 2008 crash was largely due to a housing bubble and reckless lending practices. But why do crashes happen? Well, markets are inherently cyclical. They ebb and flow in response to economic factors and investor sentiment. During periods of economic growth, confidence fuels investment, pushing stock prices higher. However, when economic conditions worsen or uncertainty rises, investors may panic and sell off their stocks, leading to a crash. It's important to note that crashes are not anomalies but an integral part of the market's cycle. They are as inevitable as the rising and setting of the sun, yet they are not the end of the world. In fact, history has shown us that the market always recovers, often reaching new heights. Moreover, it's worth mentioning that crashes can create opportunities. As the saying goes, buy when there's blood in the streets, signifies that market downturns can present rare chances to buy quality stocks at discounted prices, provided, of course, you've done your research and know what you're buying. Understanding the nature of stock market crashes can help us prepare and navigate through them. By knowing what causes them and how they have played out in the past, we can put ourselves in a stronger position to weather the storm when the next crash inevitably comes. After all, forewarned is forearmed. Now let's talk about diversification, your first line of defense against market downturns. Diversification, in the simplest terms, is the spreading of investments across a variety of assets to reduce exposure to any one particular asset. It's the investment world's version of not putting all your eggs in one basket. The rationale behind this strategy is to mitigate risk. If one investment performs poorly, the others might perform well and offset the loss. But how can you achieve diversification? Well, there are several ways. First, you can diversify across asset classes. This means investing in a mix of stocks, bonds, commodities, and even real estate. Each of these asset classes tends to behave differently under varying market conditions, providing a safety net during downturns. Secondly, diversification can be achieved by investing in different sectors or industries. The performance of sectors can vary greatly. For example, while the technology sector might struggle, healthcare or utilities might thrive. By spreading your investments across sectors, you reduce the risk of your portfolio being hit hard by a downturn in any one sector. Lastly, geographical diversification is another avenue to explore. Markets in different regions or countries can perform differently due to a variety of factors, including economic conditions, political stability, and exchange rates. By investing in international markets, you can cushion your portfolio against the volatility of any one particular market. In essence, diversification is about balance. It's about spreading risk so that your investment portfolio can weather the storm of market volatility. It's not about chasing the highest returns, but rather about minimizing potential losses. But remember, while diversification can help mitigate risk, it does not guarantee profit or protect against all loss. It is one tool in your investment toolkit that should be used in conjunction with others, like staying informed and having a long-term investment strategy. A diversified portfolio can help mitigate the risk and potential damage of a market crash. It serves as a buffer, a shield, protecting your investments from the full impact of market downturns. So, as you build your investment portfolio, remember the power of diversification. It's your first line of defense in preparing for a stock market crash. Knowledge is power. especially when it comes to investing. In the dynamic world of stocks, staying on top of market trends and news is not just beneficial, it's crucial. It's like being the captain of your own financial ship, navigating through the ever-changing seas of the stock market. Now you may wonder, why is staying informed so important? Well, the stock market is a reflection of the world's events and economic health. Political decisions, technological advancements, natural disasters, they all have the potential to cause ripples in the market. By keeping a close eye on these happenings, you can anticipate shifts, identify potential risks, and spot lucrative opportunities. Being informed is not solely about being reactive. It's also about being proactive, about actively managing your investments. This includes regularly reviewing your portfolio, adjusting your strategies as needed, and not being afraid to make changes when necessary. Remember, the goal here is not to predict the future, but to prepare for it. This active approach can also help you better understand the nature of your investments. Are they high risk, high reward, or are they more conservative, offering steady returns? Understanding this can help you balance your portfolio and mitigate risks, providing a safety net during market downturns. And let's not forget the role of financial literacy. Understanding financial terms, interpreting market data, knowing the difference between a bear and a bull market. These are all part of being an informed investor. It's like learning a new language, the language of finance. And the more fluent you become, the better you'll be at navigating the market's ebb and flow. So, if you're looking to safeguard your investments against market crashes, remember this. Staying informed and active is key. It's about understanding the market, managing your investments, and adjusting your strategies based on this knowledge. It's not about timing the market, but about time in the market. Staying informed and active allows you to make timely and informed decisions, reducing the impact of market crashes. It's your compass in the vast sea of investing, guiding you towards financial stability and success. Investing is a marathon, not a sprint. Let's discuss the importance of a long-term investment strategy. Imagine you're on a road trip. You wouldn't panic and abandon your car every time you hit a pothole, would you? Similarly, in the journey of investing, market downturns are like potholes, temporary setbacks that you can overcome with a sturdy vehicle. In this case, a long-term investment strategy. Now, why is a long-term strategy so significant? It provides you with the ability to weather market volatility. Like the ebb and flow of the tide, markets have their ups and downs. A long-term approach allows you to stay invested during these market fluctuations without being swayed by short-term uncertainties. Moreover, a long-term investment strategy positions you for long-term growth. Time is an investor's best friend. The longer you keep your money invested, the more you allow the magic of compounding to work in your favor. But remember, a long-term investment strategy isn't just about holding on to your investments for a long time. It's about aligning your investments with your long-term financial goals. Whether it's buying a house, funding your child's education, or building a retirement nest egg, your investment strategy should reflect these goals. It's also about being patient and disciplined. The stock market isn't a get-rich-quick scheme. It rewards those who demonstrate patience, resilience, and a commitment to their long-term goals, even in the face of market downturns. And finally, a long-term strategy is about making informed decisions, not impulsive ones. It's about conducting thorough research, understanding the fundamentals of the companies you invest in, and keeping a close eye on market trends. In conclusion, a long-term investment strategy is like your roadmap for the investment journey. It helps you navigate market crashes, stay focused on your financial goals, and ultimately, reach your destination. A long-term investment strategy can help you stay the course during market crashes and achieve your financial goals. Preparing for a stock market crash doesn't mean living in fear. It's about arming yourself with knowledge and strategies to safeguard your investments. Let's recap the key points we've covered in this video. Understanding stock market crashes is crucial. They are sudden drops in stock prices, and while they can be alarming, they are not the end of the world. Diversification is your first line of defense. By spreading your investments across different asset classes, you can cushion the impact of a market downturn. Staying informed and active is equally important. Keep an eye on market trends, conduct thorough stock research, and don't be afraid to seize buying opportunities during market dips. Last but not least, remember the value of a long-term investment strategy. It's not about timing the market, but time in the market that counts. This approach can help you weather market storms and come out stronger on the other side. Remember, the goal is to be prepared, not scared. With the right knowledge and strategies, you can navigate any market downturn with confidence. In this journey towards financial literacy, you're not alone. You're part of a community of like-minded individuals who are striving to make informed investment decisions. We're here to guide and support you every step of the way. So, if you found this video useful, make sure to hit the like button and subscribe to our channel. This way you'll stay updated on our latest content designed to empower you with the knowledge you need to navigate the financial world. And, if you've already subscribed, we appreciate your support. Leave a comment below saying "I subscribed," and we'll do our best to respond to your comment. We love hearing from you, and your feedback helps us create better content. Remember, the more you learn, the better you'll become at managing your investments, and the more prepared you'll be for whatever the market throws your way.